Hold on to your hats and put on your seatbelts, 5-point harnesses if you want. We just finished an exciting week. We are going into another potential doozy. So the last 2 weeks, these two green candles are the most violent I've seen since the pandemic. Maybe 2022 March would be about the same. Needless to say, it was exciting, and potentially a more violent week is coming because it's going to be very Fed-centric. We are still looking at the S&P chart only on a daily. So you can see how the freak out moment, Thursday the 1st, Friday and Monday the 5th, 3 most violent days I've seen in a long time, they have completely been erased. Was we fell apart from an accident scene and we just got back to it. Normally, a stock chart that does that rests and takes some consolidation steps a little bit lower in order to break out. The good news, if it does break out, it has 6,000 as the target. Just trace out the purple lines. An inverse head and shoulders would have 3 targets, the highest of which would be 6,000. We have Jackson Hole. The Fed has been very friendly. The market has been very healthy. We are still at all-time highs. Employment reports came out friendly. Economic reports are coming out friendly. So now market sees good news in the economic conditions as good news because they have been assured a rate cut in September. So the threat is, what if he doesn't cut? Let's assume he's going to cut. Half point, quarter point. So the forecast would be split in 2 ways. One, the start of a new rally between 5 and 6% gets us maybe to 6,000. The other scenario, a nominal dip, a small dip to gather some speed and break out. Those are the 2 behaviors of a stock chart that looks like this right here, right now. Should the Fed cut? It's debatable. Should the Fed cut on a systemic basis? My opinion is a flat out no. But a cut now in order to appease the market so we don't freak out, logical. To stay ahead of the curve, so to speak, logical. Now, speaking of curve, it has been steepening. In fact, it went flat. And coincidentally, during the biggest drops. So is that a cause and effect or just a coincidental thing? This is the visual for the yield curve. It was inverted. It has been inverted. 2 years later, it's uninverting, and some people are saying that will in turn also bring a recession. So let's just ignore it and say maybe it's a coincidence that the day it inverted back was the 5th. Coincidence or not, I don't know. So if that is not a coincidence, then I, as a bull, should worry about this coming back up to here. And you can see, just like the stock market, it is making higher lows and higher highs. So how do I trade this mess? As an investor, patience will pay. Nibble into stocks that have fallen into solid support zones. Be ahead of the curve. Jump into stocks when they become cheap, like we did with Nvidia, for example. Traders, on the other hand, can actively trade this market. We're looking at the S&P, so I would be ready to buy the dip within the ranges that we have, and I would be ready to chase the breakout if it starts. I do both, and right now I'm wearing the hat of a trader. When markets freaked out and sold off Nvidia down to the 2 digits, I wore the hat of an investor and I said, give me stock, and I sold puts and I shared them with you. I don't want to be in the trenches of short-term trading because it's just a lot of busy work and a lot of unpredictable movements. It is okay to do it with a small amount of money, but in my book, it pays to zoom out and fight the fight from headquarters, as they say. My thoughts about the Fed. They have a tough job, and they've painted themselves into a corner. On the one hand, they're there to help us out. On the other hand, there aren't any obvious signs of sickness. So they are scheduled to dole out some medicine in terms of rate cuts, even though before we show any symptoms. They want to stay ahead of it. A very fine line when it comes to is this good practice or not. We do have to acknowledge the geopolitical risks that exist right now. They're a little bit higher than normal. We do have to acknowledge the US elections, the process has been, let's just say, less than smooth, and I anticipate it heating up as we approach those. The stock market is still super healthy. Main Street America is showing signs of struggle. The small caps is not mainstream America. These are still large companies. And it needs to have an incredible week this week for me to say, okay, the 6,000 scenario in the SPX is unfolding. Right now, they have only erased half the August drop. Hopefully, we have a reasonable week so we don't say, can you believe what happened next week on Sunday night? Peace out.